Good afternoon, everyone, and welcome to our annual Proxy season preview. My name is Gordon Raman, and I'm a partner in the Capital Markets and M&A group at Fasken here in Toronto, and I also chair our firm's ESG and sustainability practice. On behalf of our co-presenters at the TMX and Laurel Hill, and all of my colleagues at Fasken, I'd like to wish you a very happy New Year. We're delighted that you could join us. I should say we're delighted also because we're doing this event in person. This is the first time in 3 years. And as is normal nowadays, this is actually a hybrid event. In addition to those in the room, we have many audience members participating virtually. So to all of you, welcome. For those that have joined this discussion before, you'll know that we have two parts to the session. In the first panel discussion, we'll be covering regulatory and disclosure updates in order to help public companies get ready for the upcoming reporting season. In the second panel discussion, we like to investigate one topic in a bit more depth. In the past, we've addressed issues such as shareholder activism and ESG. In fact, the last couple of years, we've addressed ESG going into greater depth in each subsequent year. And this year, we're coming back to the same topic because it continues to be top of mind to many investors and many corporations. And this year, we're coming at it from the perspective of investors as well as corporations. Before we kick off, a couple of housekeeping matters. For those of you online, within the next week or so, you will be receiving an email with CPD information, as well as a link to the recording and the PowerPoint presentation that you'll see on the screen. If you have any questions, feel free to use the question box, which I think should be on the bottom right of your screen. For those in the room, feel free to raise your hands and somebody will come by with a microphone. And at the end of each panel discussion, we'll save some time for question and answers. So, without further delay, let me get into introducing our first panel. We have beside me Valérie Douville, Senior Compliance and Governance Advisor at TMX Group. Valérie is based in Montreal, and she's a senior securities lawyer with in-depth knowledge of the Canadian capital markets, having been in private practice before joining the TMX. And at the TMX, she focuses on issuer-facing compliance and governance matters, whether at the time of original listing or on an ongoing basis. And then we have Bill Zawada, Vice President of Business Development at Laurel Hill, based in Toronto. Bill is responsible for business development, relationship management, and strategic solutions for clients in Eastern Canada. Bill provides guidance to management, boards, and shareholders on corporate governance, shareholder engagement, and shareholder activism matters. And Justine Connors. Justine is a partner at Fasken, based in the Toronto office, and is a member of the Capital Markets and M&A group at the firm. Justine advises clients on a wide range of transactional matters, including mergers and acquisitions, private placements, public offerings, and securities regulatory matters, and stock exchange requirements. So welcome to all of our panelists. So we're going to cover a range of topics. The first one I'd like to start with, Bill, I'm going to turn to you. Each year, as companies get ready for reporting season, we're always curious about how the proxy advisory firms, ISS and Glass Lewis, how they're approaching reporting season, what are their updates. Can I ask you to walk us through the ISS and Glass Lewis changes for this year?
Great, thanks very much, Gord. Pleasure to be here. I'm going to walk through, I guess, 6 key areas that ISS and or Glass Lewis have provided some updates and clarifications on this year. I'll start with gender diversity, certainly something that obviously continues to get considerable attention, and we're seeing a convergence towards 30%, a 30% requirement from both ISS and Glass Lewis, yet there are some important differences. So the ISS, for its part, has, in one sense, they've not changed the numbers that they're looking for this year. They continue to look for at least 30% female representation on TSX composite boards, and they look for at least one female on TSX non-composite boards. In both cases, what's changed this year is that you're no longer going to get a pass if you have a policy and a target and you fail to meet those objectives or those numbers, except in very limited circumstances, as they've described as, extraordinary circumstances where, for whatever reason, you had met that number, but you've dropped off it since the last AGM, and you've provided a plan to reach it by the next AGM. and also in the case of recent, graduates either to the composite or to the exchange itself. So that's the ISS side. Glass Lewis is moving from a numerical system to a percentage. So from at least 2 gender diverse directors to 30%. That's across all TSX issuers. If you have less than 30%, but at least one, that will likely gain you a negative recommendation for the committee chair. And if you have none, a negative recommendation for the entire committee. Except that, unlike ISS, Glass Lewis will or may refrain from issuing a negative recommendation if you have a policy and a target and demonstrated progress towards achieving the targets. Racial diversity is something that continues, or that's gaining, more and more attention. ISS has basically telegraphed that for 2024, they're going to be looking for at least one racially or ethnically diverse member on the board, but may abstain from issuing a negative recommendation if there's, if you've had one in the last 2 years, and there's a commitment to have one by the next AGM. In the case of Glass Lewis, there's no new or existing policy, and they've not telegraphed anything for the future at this point. Certainly, I think that's something that's it's gaining more attention, particularly in the U.S. I think we're early stages in terms of hardline expectations here, but it's certainly something that's gaining ground.
Just one quick comment on both of those points. I mean, NASDAQ, as you know, I think we mentioned in last year's session, NASDAQ has been upfront on racial diversity. Canadians are catching up a little bit behind. On the 30% requirement, I think the latest stat that I saw was something around, for TSX companies generally, the average is around 26% for TSX. S&P 60 companies, there it's 36%. So the large companies are well above the requirements. So there may be some catching up with some of the smaller companies.
Just moving on to environmental and social risk matters, we're seeing growing expectations of board oversight of E&S risk, particularly on the Glass Lewis side. So Glass Lewis now expects all TSX composite issuers, and they've expanded this from the TSX 60 from last year, to provide oversight of disclosure of the board's oversight of environmental and social risks. And that can be assigned to either the entire board or to specific committees or individuals. ISS doesn't have a specific policy around this, but it's important to note that this consideration does figure into their to their ISS quality score. So it certainly would be valuable from the ISS side as well. I think what's probably more notable is that both proxy advisors this year have introduced expectations with regards to disclosure for what they consider to be significant GHG emitters. So in the case of ISS, they are looking for TCFD type disclosure for what they consider to be significant GHG emitters, which they've in fact limited to members of the Climate Action 100 plus focus group, which for all intents and purposes is 6 companies in Canada. Likely they're looking to kind of start small, test their model, and perhaps expand that in the future. But they're looking for disclosure of risks and targets. Like ISS, Glass Lewis is looking for similar disclosure, except that they've not limited it to the focus group list. They've simply said that for issuers where GHG emissions are considered a materially financial risk. They're further expecting specific disclosure of the board's oversight of climate risk, in addition to more broad disclosure of E&S risk. Cybersecurity is another area, and in the case of Glass Lewis, they're basically they're saying that they'd like to see disclosure of the board's oversight of cybersecurity risks. That would be beneficial. that won't give you a negative recommendation in and of itself if you're missing that. But in the event that you have, a cybersecurity event that causes significant harm to shareholders and you're missing that disclosure or it's insufficient, that could lead to negative recommendation. I think for purposes of the slides, if you wouldn't mind moving to the next slide, we'll talk a little bit about overboarding. There's really both ISS and Glass Lewis are sort of tightening up their expectations in this area. For TSX, there's no change per se for TSX issuers. What ISS has done is they've applied their TSX policy to all venture issuers as well. So just to remind everyone, that means that, in the case of non-CEO directors, they should not sit on more than 5 public company boards. A director who's also the CEO of a public company should not sit on more than 2 boards in addition to their own, where they serve as CEO. Glass Lewis is similar, but a little stricter. They actually don't look at just CEOs, but they look at positions as executives of companies. So, directors who are sort of not public company executives should also not sit on more than 5 boards. A director who is an executive of a public company should not sit on more than 2 boards in total, including their own. So basically 1 outside board, and if they they can sit on their own board, but they can't sit on more than 1 outside board. So that's really a clarification from Glass Lewis. Multi-class share structures is something that got quite a bit of attention in the past year, particularly with the situation at Rogers as well as Shopify. And Glass Lewis last year introduced a policy that essentially required a sunset provision for multi-class share structures, generally considered to be 7 years or less. ISS has no such policy. But what Glass Lewis has done this year is really kind of updated and clarified that the negative recommendation may, in fact, be directed to a representative on the board of the superior voting class. Instead of perhaps the chair of the governance committee, and that they may also exempt companies from a negative recommendation where they otherwise demonstrate, exemplary governance and board responsiveness. And finally, compensation, always a hot topic. Not a tremendous amount of update here, except that Glass Lewis has upped their expectations that long-term incentive plans be at least 50% based on performance criteria, up from 33% last year. That really aligns with ISS and with the market trends. They've provided some other clarifications, some really sort of technical related to equity awards, but just a couple of other things that are of note is that in the case of multi-class share structures and say on pay votes, they will in fact look at the vote of the subordinate class in determining the need for board responsiveness. So even if you don't provide the disclosure of how the 2 classes split in terms of the vote results, they'll do the math. And if you're under the 80% approval threshold, they'll look for board responsiveness from you. And the other thing that is interesting is that where you're using discretion to determine, short-term or long-term incentive pay, they're expecting greater disclosure of the rationale for any such discretion. Pardon me.
That's great. Thanks very much, Bill. There's one point that you mentioned I wouldn't mind touching on, which is board oversight over ESG issues. Fasken released its ESG disclosure study a couple of days ago. One of the data points that we actually looked at were how are boards approaching ESG oversight? Are they allocating the responsibility on ESG oversight to a particular committee? Are they keeping it at the board level? Are they sharing responsibility? So there's a couple of slides that might be useful. What we looked at was ESG oversight both on E issues, environmental issues, as well as social issues. And This is the slide on oversight over environmental issues. And it really shows that committees have a huge involvement in oversight of ESG matters. So when you look at the percentage of companies that allocate responsibility to a committee alone or to a committee with help from the board, it's quite a large number. The graph on the left are the TSX 60 companies, and the one on the right are the CEC 40. So that's Climate Engagement Canada. Climate Engagement Canada does something similar to Climate Action 100. So rather than 6 companies that are identified by Climate Action 100, which is a global organization, Climate Engagement Canada has identified 40 that they think of as high emitters. If we go to the next slide, and this is the breakdown of how oversight of social issues is allocated. Again, committee involvement is quite substantial. And it kind of makes sense because many of the issues that you deal with, particularly on the environmental side, can be very technical, and boards rely on the expertise that's contained in their committees to help fulfill their obligations on oversight. So, Valérie, can I turn to you to help us and help the audience understand the things that have been happening at the TSX and the TSXV and what's new?
Yeah, sure. Okay, so I'll start with a few updates on TSX. So TSX has for a long time taken a close look at voting covenants between or among issuers and one or more of their security holders. So we review covenants that require security holder to vote with management, so in favor of their proposal or whatever they put forward. So TSX generally opposes to those voting covenants with concerns of control because it has an effect on control. So we've been looking at those for a really long time, but we are soon publishing staff notice that will really set out, well, the current practice, what we look at, and where we can be a bit more flexible in some circumstances. Second slide. Yeah, okay, so we've also put out a request for comments on prospectus offerings. So this is section 606 of the TSX company manual that set out the criteria that we review prospectus offerings. So essentially, we review prospectus offerings to make sure that they are really a public offering and that they are bona fide public offering. And if we consider that they're not, then we will review them under our private placement rules. So one of the things we look at is the pricing. So what we consider to be generally okay, or that we will consider as a public offering, is when the offering price is below a 10% discount to 5-day VWAP. So what we're proposing is to set standards in the manual as to exactly what we mean when we say bona fide public offering. So we're going to look at 3 factors. So whether the offering has been broadly marketed, the offering price, and insider participation. On the broadly marketed, what we're proposing is to define it as 2 things. So either at least 50%, so that it was distributed or offered to at least 50 purchasers, or that the offer was made known to a selling group and or an equity capital market desks at all Canadian investment dealers. On the offering price, we're generally of the view that difference should be made to the board of directors when they're exercising their fiduciary duty. So what we're proposing is to generally accept the offering price of the securities offered, regardless of the discount. However, this is assuming that the public offering was broadly marketed and that there's no insider participation. What we're also proposing on the offering price is to use the closing price, meaning the most recently completed trading session of the issuer's securities, rather than the market price, meaning the 5-day VWAP, as a reference price when we're analyzing discounts on prospectus offering. And then the last thing we're looking at is insider participation. So essentially, if there are insider participation, we'll take a look at the offering price, and if it's priced at less than 15% discount and the insider is participating to keep its pro rata up to a maximum number of shares to keep its pro rata, then it's fine. We'll consider it a public offering. However, any portion over that pro rata shares will be reviewed under our private placement rules. And then also, if there's insider participation and the offering price exceeds a 15% discount, then we will review that insider participation under our private placement rules. So this is what we're proposing, and we're really inviting everyone to make comments, even if it's to say that you agree and you think we've done a fantastic job, but we're really looking for comments. I think we have it until January 31st, something, yeah. Okay, so if there's no questions, I'll move to some updates on the venture market. So fresh off the press on January 1st, we amended our policy on fees. So this policy had not been changed since 2011. So it was in the real need of a refresh. We wanted to respect current market environment, address some pain points that were identified by some of our stakeholders, and then to take obviously some consideration to inflation. One thing is we had two documents, so now we consolidated Schedule 1A into Policy 1.3. So essentially the policy really is rewritten, provides better guidance, and addresses some areas of confusion. One of the things it does is it introduces the concept of listing capitalization. So for those of you who are familiar with TSX, it's the same methodology used on TSX. It's actually the same methodology that venture used, but now it's just better defined. Something else it introduces is a flat fee for most transactions of $1,000. So that means that there's an increasive fee on some transactions, but also a decreasive fee on some transactions. Another thing fresh off the press is on January 1st, we rolled out into Links. Links is for those who don't know, is our hub where we manage submissions from issuers or from lawyers on behalf of the issuers. So we've rolled out an enhancement on the securities-based compensation plan submission. One of the great feature is that now there's a form, so securities-based compensation form that you can fill out, and it will indicate what kind of plan is submitted. Is it new? Is it amended? When did shareholders' approval was last obtained, or when are you going to the printer? So it's gonna be really helpful for staff, but also for you guys. So for example, it's a really useful tool to know when do you need to go back to shareholders to get shareholders' approval for your plan. And then staff will also have information available, especially if you're going to the printers and you set it out on the form, we'll know right away. Another great feature is that you'll be able to pull your submission, like the submissions you've done in former years. So for example, staff will be able to do like a compare version and know exactly where the amendments are. Another change on venture last year was a change to the minimum pricing requirement. So during COVID, venture granted temporary relief for the minimum price at which listed shares can be issued. In 2022, venture permanently amended several of its existing policies to incorporate the minimum pricing requirements. So essentially, it amends a bunch of policies, but essentially what's really important is that it amends the definition of discounted market price and the definition of market price. So in short, market price of an issuer, if the market price of an issuer is lower than 5 cents, then the minimum price at which the issuer can issue shares, including the discounted price, is now set at 1 cent. And for an issuer having a market price greater than 5 cents, then the minimum is 5 cents. There are certain exemptions for exchangeable securities where the minimum price is staying at 5 cents. And then last thing I just wanted to point out is Venture Forward. So Venture Forward is in 2022, and we're going to be continuing in 2023. We're doing like a deep stakeholder engagement. So we really want to meet with stakeholders, gather some insight, gather some information, really to make venture is great. We want to make it greater. We really want to keep our competitive edge. Like it says on the slide, like more granularly, we want to find ways to reduce barriers, burdens for to access to capital market, public venture capital, I should say, expand the global base of investors and capital that support the finance issuers, and we want to empower and strengthen the public venture capital ecosystem. So I invite you to go on our website. In the slide it says we put the link. So if you want to engage with us, like I really invite you to click on that link.
I mean, that's a great initiative. I don't think any of us should forget how important a public venture capital market has been for Canada's development of many of its companies and industries. One thing I wanted to just put some context around, the very first point that you mentioned was around voting covenants, and people might wonder, well, how do you get a voting covenant in a public company? So these would be instances where, for example, you have a PIPE transaction where an investor is investing into a private placement of a public company, a large amount of money, and enters into an investor rights agreement that provides some sort of voting rights. Is that the context?
That's one of the contexts. You have also in the context of an acquisition, you'll see that. So yes, in an investor rights agreement, you'll see also in shareholders agreements. That's the majority of it. So some cases, you can see where when there's a proxy fight, you'll see an investment rights agreement that will be negotiated with nomination rights. And then you'll have some voting covenants kind of built in those nomination rights.
Very helpful. Thank you. Justine, I'm going to turn to you next. And if you could help us understand some of the regulatory and continuous disclosure updates that have percolated and what issuers should be thinking about as they get ready for reporting season.
Sure. Okay, thanks, Gord. So back in November, the Canadian Securities Administrators released a staff notice setting out the results of its continuous disclosure review for the 2 years ended March of 2022, I believe. The notice is very long. I'd encourage everyone to read all of it, but we definitely don't have time in this session to go through or even summarize every point. So where I think I want to focus our time is on their comments on how issuers are doing on following National Instrument 52-112, that's non-GAAP and other financial measures disclosure. So you may recall back in 2021, this instrument replaced a previous staff notice on non-GAAP financial measures, and it distinguished non-GAAP financial measures from other measures such as non-GAAP ratios, capital management measures, supplementary financial measures, and total segments measures. So how are issuers doing with this new instrument? Earnings releases, apparently an issue that issuers are not including the quantitative reconciliation required in the earnings release. So the instrument does allow for incorporation by reference to your MD&A in most cases for the reconciliation, but earnings releases are an exception to that rule. So if you're doing an earnings release, make sure you put your reconciliation in there. Non-GAAP measures cannot be more prominent than the most closely associated GAAP measure. Now, this isn't new. This would have been in the staff notice, but the CSA has now provided comment that using two non-GAAP measures that are similar in purpose, where one would maybe do, they'll consider that occasionally to be obscuring the GAAP measure. So be careful where one will do. Use one, don't use two. Non-GAAP measures that are forward-looking information. So you can't just rely on the general forward-looking information rules in 51-102. The national instrument actually has specific rules set out for non-GAAP measures that are FLI, and you need you need to explain the difference between the forward-looking non-GAAP measure and its historical equivalent. So to give you an example, if you were projecting, say, net income of $300,000 for 2023, you also have to have in the disclosure that your net income for 2022 was $200,000 and you explain the $100,000 difference. Another thing the CSA noted is that total of segments measures aren't being properly identified. So that's a measure that's disclosed in the notes to the financial statements. But it has to be disclosed in accordance with the entity's GAAP. So for example, IFRS 8 operating segments. So if it's not disclosed in accordance with the entity's GAAP, then the CSA may require it to be actually removed from the financials entirely. And if it's removed from the financials entirely and you still want to use it, it's now a non-GAAP measure. It's not a total of segments measure. And the more heightened requirements for non-GAAP measures would apply to that disclosure. Supplementary financial measures. So some issuers are apparently using confusing labels to describe supplementary financial measures. And one example the CSA gave was backlog. So backlog is generally understood to include firm purchase orders. So if you want to disclose firm purchase orders in your definition of backlog, but also, letters of intent and outstanding proposals, don't use backlog, use adjusted backlog, and then obviously you're going to explain what you're adjusting for. And perhaps my favorite comment, investor presentations, issues with attempted incorporation by reference. If you are attempting to incorporate by reference in your investor presentation to an MD&A, do make sure the MD&A is filed and publicly available. Moving on to a few other deficiencies that they noted. Oh, we're still on the, yeah. So I think I'll just go through, a couple of these. On MD&A, a reminder for early and development stage issuers that any announcement of a significant project has to be accompanied by the disclosure of the timing and the milestones associated with the project, and obviously significant disclosure around the cost for each and where the issuer is in terms of meeting each milestone. And then the last thing I wanted to mention in respect of this staff notice was what the CSA calls hot topic number 1. Apparently there's been some confusion about the difference between a significant acquisition and a restructuring transaction. The latter includes transactions such as reverse takeovers, and usually requires prospectus level disclosure and perhaps a shareholder vote rather than a business acquisition report. And I was thinking, I definitely would not want to be on the receiving end of the comment where you filed a business acquisition report and you get a call from a commission saying that they think you've done a restructuring transaction. So wanted to highlight that. I think we can go to the next slide.
Just before this,
Yeah.
I should note, for those of you who have not read 52.112 or have read it once, you probably need to read it 3 or 4 times. It is not easy to understand, and it's not something that you want to read the night before you file your MD&A, as experience tells you. It's a pretty dense document, and it does require a bit of discussion with not only your finance professionals, but also your accounting professionals.
Yes, I had to read it more than once before this presentation, for sure. Moving on to some exciting stuff, a couple of new prospectus exemptions. And I say exciting because in particular in respect of the listed issuer and financing exemption, this actually allows certain listed issuers to issue freely tradable securities without a prospectus. So no 4-month hold. This is obviously not the norm for private placement. And the offering document's sort of a 5-pager in Q&A style, and it's not reviewed by the commissions. Well, it could be reviewed by the commissions in connection with a general review, but it's not, reviewed prior to an offering like in the way a prospectus would be. There are pretty low limits on what you can raise. So during a 12-month period, an issuer can raise up to the greater of $5 million or 10% of their market cap, but that itself is maxed out at $10 million. I think Valerie had some comments on how the exchanges are going to treat this.
Valerie, just on the TSX approach on this exemption?
Yeah, sure. So on TSX, we're going to be reviewing these under our public offerings, so no hold period. On venture, we are still looking at it under our private placement rules. However, there's no hold period. So just a quick comment on that. On venture, we had some venture hold periods. So we decided to remove venture hold periods for not just for the life exemptions, but for all life private transactions. So we'll rely on the securities law, except for securities issued to insiders, consultants, officers, directors, shareholders with nomination rights, where we maintain some rules on the hold periods.
So the next exemption I wanted to talk about is the self-certified investor exemption. So this is an 18-month pilot project under an Ontario instrument. So it's important to note it's only going to apply to issuers with head offices in Ontario and selling to Ontario residents. But what it does is it allows these issuers to raise small sums of money from certain investors, who the Ontario Securities Commission deems have relevant education or work experience. So CFAs, MBAs with a focus on finance, people who have management, policy making, engineering, product, or other relevant operational experience at a business in the same industry or sector as the issuer, lawyers practicing securities law or M&A, yay. Now the limits on this one are small too, $30,000 a year, and that limits on the investor, not the issuer, and the investor has to fill out an acknowledgement form and represent to the issuer that they're not going above their cap. I think there's similar exemptions in Saskatchewan and Alberta, I believe. This one not quite as exciting because we still have the 4-month hold, just like a regular old accredited investor private placement. Coming soon,
Yeah.
or?
Yeah, I would hit those really quickly, and then we're going to hit a couple other topics.
Sure. Coming soon, access equals delivery. So this is not in force yet, but this proposal would permit certain prospectuses, financial statements, and MD&A to be delivered electronically for non-investment fund issuers. So your delivery obligations would be satisfied by a CDR filing and issuing a news release in most cases. And then also coming down the line, proposed changes to 43-101. I don't think 43-101 has been amended since 2011. We don't even have draft legislation on this yet. The comment period, it's just a consultation paper stage. But we do know that the changes could be far-reaching. They've asked 38 questions, and they're pretty much on every part of 43-101. So hopefully by next year we'll have more of an update on that.
That's great. Thank you very much. In the time we have left, there's a few things. I'd like to maybe do a lightning round on a few of these. Majority voting, particularly the amendments to the CBC. Valérie, do you mind just touching on that? Because the TSX has had a majority voting rules for a while, but the CBCA has just come into force. A couple comments?
Yeah, just a few comments. So the CBCA has introduced like true majority. That we, so you're not elected if you don't have a majority of the votes in favor. TSX, when we introduced that, because of corporate law, essentially, the way we did it is that if a director does not obtain a majority of votes in his favor, has to resign, and then the board of directors have to accept the resignation unless there are exceptional circumstances. And so the reason I'm saying all this is that we found, since we've introduced majority voting, is that exceptional circumstances piece was really important, because some shareholders have used majority voting requirement for purposes other than what we intended, meaning engagement with directors and making sure they're accountable. So so the CBCA obviously is more rigid because there's no carve out for the exceptional circumstances. And then the second thing I just wanted to point out is that now any venture issuers that are under the CBCA jurisdiction are now subject to the majority of voting, which may, like, some of those issuers are a bit more fragile or might have an impact. It'll be interesting to see.
Thank you. Yeah, that's an important point to not forget. Justine, you want to cover the updates to shareholder proposals?
Sure. So the CBCA has been amended now that the deadline for shareholder proposals, shareholder proposals have to be submitted now in a 60-day window, ending on the 90th day before the anniversary date of the last meeting. And it used to be the 90th day before the anniversary date of the notice of the meeting. So what it essentially does is it gives shareholders more time, like closer to the proposed meeting date, to submit a proposal.
Thank you. And Bill, just a comment from you quickly on how activists can use either majority voting or shareholder proposals as a tool of activism. What do you see?
So just pick up a little bit on what Valérie was talking about in terms of the impact for venture issuers in particular. I mean, certainly if you're a TSX issuer and you've had majority voting for a number of years, this is not a significant change, but it is a more blunt instrument now in terms of a potential activist coming at you, and now you simply, if you fail to vote, you're not elected. You don't have the option to tender your resignation, and the board, potentially reject it. So I think if you're an activist, that's potentially a more appealing tool for you. But for venture issuers in particular, who've never had a majority voting mechanism, and who are already the target of about 70% of all activism, this is a new risk for them. And they already have low voter turnout at their AGM. Typically have weaker governance and weaker activism defenses. So potentially an area for increased activism, and we think we'll probably see some of that this year and in the coming years.
That's great. Thanks, Bill.
Yep.
Okay, last slide. We have a couple of grab bag items. Justine, maybe what happens down in the U.S. often filters up here a couple of SEC updates.
Yeah, so the SEC's proposed changes to Schedule 13D and 13G under the U.S. Securities and Exchange Act. So that's the beneficial reporting system in the U.S. So the 13D is kind of the equivalent of our early warning report, and the 13G is our alternative monthly report. The first change is on timing requirements. So they've shortened the windows of when you need to file to look a little bit more similar to what we have in Canada, actually. But the more interesting change is actually that the SEC is now going to be including, if the proposal goes through, beneficial ownership of certain cash-settled derivative securities. They're going to be, including beneficial ownership of certain cash-settled derivative securities as beneficial owners of the reference security. So if the instrument's held with the purpose of influencing control of the issuer. So this is sort of aimed to stop activist investors from building up like hidden positions economically. And it's just interesting because usually, these disclosure rules are based on voting power, not economic interest. So this is sort of an attempt to change that. Compensation clawback rules. So this will be enforced as of January 27th. So this is going to be sort of a forced clawback policy of incentive-based compensation if it was erroneously awarded. And basically what that means, if there was an accounting restatement due to material noncompliance with financial reporting. And what will be clawed back will be the pre-tax amount in excess of what would have been awarded had the financials been correct. And this actually will apply to, I think it's all U.S. listed companies and even foreign private issuers. So this one's pretty broad.
And that's going to be an interesting one to watch, particularly when we get into the second panel discussion on executive comp and ESG disclosure and where this all goes in the future. So thanks, Justine. Valérie, we were just talking about this earlier, this On the Board series, which is a treasure trove of information that not everybody might be aware of. So
yeah, so it sounds a bit like a plug, but it's a really amazing tool we have on our website. So if you go on our website, we have the Learning Academy or ESG 101, and there's amazing tools on that. On that, there's stuff on ESG and then on corporate governance. But just like for this panel, I thought I'd point out we have the On the Board series. So it's a Part 4 series, and it gives a lot of data, insight, and research that our teams did that would be very useful for preparation for Proxy season.
And Bill, last word to you. Just as I said, our event here is hybrid. People have not moved away from doing things virtually. What about virtual shareholder meetings? Do we continue with that? What's the story?
I think we do, but certainly hybrid is going to be the gold standard going forward. Obviously, issuers have enjoyed to some extent, the perhaps the greater simplicity of a virtual only meeting, the cost effectiveness, being able to reach a greater number of shareholders. And shareholders have also been, enjoyed the being able from anywhere in the world to participate in meetings over the last 3 years. But I think going forward, there's still a shareholder appetite for in-person meetings. Have somebody that's been involved in shareholder meetings for many years, and there's a few where it's a handful of people sitting around a board table and it's over in about 3 minutes. But for the most part, shareholders still like to go up to the microphone, ask their question, look the chairman in the eye, talk to other shareholders, talk to the board, talk to management, before and after the meeting. There's a dynamic there that, I don't think, they're interested in foregoing. So I think, going forward, virtual, in the short term, I think, virtual only may be appropriate this year. Certainly, the banks and some of the insurance companies have indicated that they'll hold and have received court orders to have hybrid meetings if necessary, planning hybrid meetings and plan to hold virtual only if necessary. And that, for an issuer that wants to have a virtual only, that probably will give you cover as long as you provide the required disclosure that, proxy advisors and some institutions are looking for. But I think in the longer term, if you want to go virtual only, I think that might be right for some companies, but, talk to your shareholders, get their views, get their expectations, and that might evolve over time. But I certainly wouldn't rush into a virtual only environment.
Thank you. We're a little bit over time, but to use Bill's words, is there anybody in the room that feels compelled to go to a microphone, look us in the eye, and ask us a question? If not, we will, the panelists will be around for the reception, so feel free to connect with any of them, either at the reception or afterwards. I don't see any questions online, but similarly, please feel free to reach out after the event. So Valérie, Bill, Justine, thank you very much for walking us through all of those issues as companies get ready for reporting season. And we're going to transition to the next panel. So if those online could hold 1 minute, we will swap seats. Okay, so now we're going to get into our second panel discussion. As I mentioned at the outset, ESG has continued to be top of mind for companies, investors. And in this panel, what we'd like to do is come at this from an investor perspective as well as a corporate perspective. How does a corporation think about ESG issues? So to help us with these considerations, let me introduce our two panelists. First, to my far left, we've got Bindu Dhaliwal. Bindu is the Vice President, Environmental, Social, and Governance at CIBC. She leads the enterprise ESG team, and she's responsible for CIBC's ESG strategy, governance, disclosure, and ESG engagement activities with CIBC's stakeholders. In joining CIBC in 2021, she brought over 15 years of experience, having previously led a sustainability team at another financial institution. Bindu has also been a long-standing community leader and an advocate for diversity and equity issues. She has served on and serves on the board of a number of not-for-profit organizations, including the Child Development Institute, the Children's Mental Health Agency in Toronto. Bindu has received the Governor General's Award in commemoration of the Persons Case. And beside Bindu, we have Alison Loat. Alison is the Managing Director, Sustainable Investing and Innovation at OPTrust, where she leads OPTrust's Responsible Investment Program, its total fund climate change strategy, and oversees an investment portfolio focused at the intersection of sustainability and innovation. Alison has previously been at FCLT Global, which stands for Focusing Capital for the Long Term, and McKinsey, and not only has she received the Queen's Gold and Diamond Jubilee medals, but she's been named one of the 100 most powerful women in Canada.
Don't mind the internet there.
And on top of all that, she's deeply committed to public service, including serving on the board of the Canadian Club of Toronto, which is where we met. And welcome to both of you. Now that I'm completely intimidated, let me see if I can rummage through my notes and see if we can carry on a discussion about some ESG issues. What I'd like to do is start with a very general question, which is most people can define ESG. They can tell you what the E, the S, and the G stand for. But what does ESG actually mean? And so I'd like each of you to come at this from your perspective. So Alison, maybe we'll start with you from an investor perspective, and then Bindu from a corporation, tell us what you think it means. So Alison, we'll start with you.
Sure. Well, thank you, and nice to be among people. I'm impressed that most people could define ESG because that's not my experience. So I think, truthfully, the term can mean so many different things that it does risk. When it means everything, it means nothing. So I do think, and we'll come to some of the challenges I think associated with the grad bag of that term, but I believe its breadth actually can often lead to its misrepresentation and its misuse. So in terms of at least how we think about an OPTrust as a pension plan, just for those who aren't familiar, we think about it really in a couple of ways. The first is a framework to assess risk and opportunity in a company or in a business. It is a really good discipline to apply, and I think a lot of people, good investors, have done that for a long time. The second way, and it's a related way, is to really systematically think through pre-financial considerations in an investment. So, there's well-developed tools about how we assess. Well, some might argue they also change, but to assess financial performance. And when done well, the consideration of these pre-financial factors actually can really help you better understand whether a company is poised for long-term growth. So those are, at least how we think about it. I do think, as I mentioned, it's good investors, good companies have thought about this for a long time. They may not have used the moniker or used the phraseology that is very open to interpretation, but they've done this kind of work. Obviously, and we'll probably talk a bit more about this, it's come to the fore, I think, you've been in this world for a long time as well. It really has accelerated, I think, in part because the COVID pandemic did expose that there are real costs when you sort of under factor or under consider some of these factors, as well as I think the increasing pressure on companies and CEOs to do more than just worry about the bottom line. So that's at least a little bit of how we think about it.
So we'll dig into that, but Bindu,
Alison, I really liked how you framed it. It is a framework for considering non-financial factors from a risk and opportunities perspective. And I think about in the last few years that opportunities piece has been added, because really where this really started was looking at it from a risk lens. And the way that we look at it is, that framework, but it's a framework to engage with our stakeholders and also look at ourselves and the way we evaluate ourselves. And I think the stakeholder piece is really important because in addition to investors, which are very important, there's regulators, there's employees, there's clients, there's community members. And I think what's really evolved in the last few years is the articulation of this framework that helps sort of allows a corporation to define what's a priority in the ESG space in accordance to themselves and their stakeholders.
Alison, I want to pick up on one thing you said, which is about assessing risk. Is it fair to say that when you look at companies and how you value companies, the efficient market theory tells us that once you take all the information about a company, you can price it into the stock, that looking at the risks and opportunities that are applicable to a company is really a way to find out what the true value of a company is? Is that a fair assessment of why the risks and opportunities are so important around the ESG space?
Yeah, I think in an ideal world, all that information would be readily available. I think when it comes to ESG, part of the challenge from an investor perspective, and no doubt for an issuer perspective, is that the lack of clarity of definition and agreement around those means that you can kind of say lots of different stuff, and it's fine if you're trying to dig in on one particular company and really understand that. But when you're looking at a massive portfolio of businesses, you want comparable information that's as reliable as possible. And so I think that's really where when the rubber hits the road from an investor perspective, I think the aspiration from an investor is to try to get more comparable, consistently disclosed information that they can actually factor with a bit more confidence than perhaps is it possible today.
Right. And Bindu, from a stakeholder engagement perspective, this is something that CIBC would have done for a long time. Does it? So I imagine some of the things you're doing might be new, but does it help ease the discussion? Does it frame the discussion easier now to kind of put this umbrella of ESG around it?
Yeah, I think so. I think, in my experience in doing this for quite a number of years, the financial institutions have been engaged in sort of stakeholder discussions. And why it may not have been ESG or even sustainability, it came on issues of diversity and inclusion or your environmental footprint, like things sort of like individual issues. And I think the framework piece that's come about now is largely tied to disclosure, but also just generally engagement, is there's now frameworks out there that help you sort of categorize and do that comparability. So we get asked, or there's an attempt to try to compare ourselves with our peers, and we get asked questions about it. So I think from a stakeholder perspective, I think it's easier for them, probably harder for us in terms of trying to then answer questions about comparability. But I think we're moving in the direction where we'll get there.
And when we look at where ESG is today, some of the reactions you get are, gee, it's just CSR all over again. It's just corporate social responsibility renamed. What's your thought on whether the term ESG continues? How should companies think about it? Is this a fad? Is this continuing? Both of your thoughts would be helpful.
Go ahead, you start and I'll go.
So I think it's an evolution, and I think it's a really interesting evolution. I don't think it's a fad. ESG, I was in a role, I think in 2012, the GC that I reported to at the time changed my role from sustainability, head of sustainability, to ESG well before, and he saw it coming. And so whether the terminology might change, I think what's really important, what's here, it's factors, framework, disclosure, whatever you want to call it. It's going to be an element in which people assess companies and organizations, and that you assess ourselves. So I don't think it's a fad. I think the terminology may change. Plus, CSR was really community-based, philanthropy, that sort of stuff. We're now at very data-driven issues and sort of backup around that. So I think it's really shifted.
Awesome.
Yeah, for those of us that work in this space, the terminology is an endless source of frustration. I think that's fair to say. I mean, sustainable investing, responsible investing, how are they the same? How are they different? On and on. With respect to ESG specifically, as I mentioned at the beginning, I think some people find it the term frustrating because they'll say, well, these are things I've been thinking about and incorporating in my business for a long time. And now you're putting this ESG and I have to write a report. No one reads the report. And, I have to do that for our organization. And it is, I can be sympathetic. So I think as we move forward, the terminology soup will continue. The acronym, Palooza will continue. But I suspect we'll probably go back to where we were, which is actually being quite specific about what we're talking about, and being much more intentional about the link to materiality from an investment perspective. And I think this is a bit of the challenge I know when we're working with companies we own, or we're partial owners of. It's like there's 800 things here, right? So it's about finding, the 2, the 4, the reasonable number that actually are going to drive value in the business, and being very clear, with your stakeholders and your, whoever they may be. In our case, we're coming at it from an investor perspective, that's why you've chosen those, and you're quite precise about what those are. So it's almost a bit of back to the future, I think, over time. But in the meantime, we just have to kind of muddle through the poor use of English.
And I'd like to come back to the materiality point. But before doing that, I want to shift to regulations. So, and we're going to come at this from a corporation's perspective. So what regulations are applicable to a corporation? There's, investment funds and so on, which we're not going to touch on. For a corporation, I think it's fair to say that there's very little that is an actual mandate. There are certainly diversity disclosures that are mandated for corporations, both under securities law and under the CIBC, under corporate law. But aside from the diversity disclosures, there's very little mandated for corporations. There are proposals from the securities commissions, both in Canada and the US, on climate-related disclosure, but they're proposals, they aren't in force yet. Despite very little mandates, issuers are disclosing things. So, Alison, do we actually need more mandates, or are you finding that investors are able to engage enough with companies to encourage them to disclose the things that investors want, and companies are complying? Do we need mandates?
Yeah, I think, a smart company will always be ahead of the regulations, I'm sure. I don't need to tell anyone in this room that. When you talk to, an investor will always say, yes, please, to more information. So, when you ask that question, the answer will always be, we would like more information. We would like higher quality information, more consistently and disclosed and comparable across companies. So you'll always get those sorts of answers. The challenge now is that it's really, I think I was happy to see, thank you for some of that ISS and Glass Lewis information, but and I manage the Proxy program for our fund, and some of the challenges, you're now facing because of the, 1,000 flowers bloom, which might be right given we're all figuring out what this means, climate particular, figuring out what this means, is that it's really hard to scrutinize that as an investor. And it's very hard, and they're often very lawyered. They have a strong, you use the term CSR, a lot of them do have more of a public relations aspect to the report versus an investor aspect to the report. So, if the regulations are appropriate, and that's still to be determined, I think we'd always prefer to see something that does push the market towards a more consistent disclosure regime. Obviously, the risk is that the market the regulations move too quickly, and the market actually can't do it well. So, I don't envy the regulators, but I think when you ask an investor, they'll always ask for more. If that makes sense. I didn't like your face suggested
No, we're
you didn't like the answer.
we're gonna dig into this. Bindu, from a corporation's perspective, are more regulations helpful because you know exactly what to do, or are you already doing these things because you know the investors want it?
And, I'm thinking back to your question about CSR versus ESG. So I think a lot of what's happened around the disclosure space, it was a very qualitative narrative before. And over the last few years, it's really drawn more to the quantitative side, largely because of the frameworks that are out there and the standards, the voluntary frameworks and standards, SASB, GRI. So I think while the regulatory stuff, I agree with Alison, will help with comparability, a bit more direction. For some of us, that have been doing this for a while, I think we've moved already to that space. It won't be as much of a lift. I think that if the regulators come out with more specifics, I think the issue will be the quantitative piece, particularly around climate, some of it is not, the data is not there. And so are people going to want the same standard as financial reporting in, let's say, climate reporting? And that's going to be the difficulty. So I'm not as worried about the regulatory pieces. It's more about the assurance pieces around it and things like that.
And that's an important point. Sorry if I can just jump in on that. We face this as well as we are we're not a corporation like you're talking about, but we also have to issue these reports for our activities across our entire portfolio, and it's not assurable. And so there's a lot of hesitation about, even if you're kind of collecting this, can we actually disclose this if it can't be, when the assurance isn't where it needs to be. And so it's much more complicated when push comes to shove, as you know, than being able to say, yes, I'd like consistently comparable information. So we're aware of that.
Maybe just talk about assurance. When we say assurance, a lot of people won't know what we mean by assurance. A simple explanation of what assurance means?
Yeah, in the ESG space, a number of corporations right now do what's called limited assurance. So they'll have their auditors do a limited, which is not and for the accountants in the room, I apologize. I know that there's a higher level of assurance to that, which is the equivalent of financial reporting assurance. But limited assurance is sort of that, it's sort of the level of standard right now for a number of ESG pieces. But for financial reporting has that one level up, the assurance that's tested and by your auditors. And that is, there are some pieces that probably could be to a level of assurance, or I think it's called reasonable assurance. I apologize. I don't know the exact accounting term. But there's a number of ESG-related data points that just couldn't be to that level, largely because of where the sources of data come from. There's so much proxying of information. There's not consistent data sources, all that sort of stuff. It's very different than financial reporting.
Okay. So regulations are one thing, but even if we get regulations, what regulators will often do is say, we want you to disclose against something, and that something is a framework that the regulators don't develop, but other organizations develop. The CSA seemed a little bit ahead of the game in 2021 when it came out with its proposed regulations of asking companies to disclose climate-related disclosures against TCFD, which is the Task Force for Climate-Related Financial Disclosures. The comment period for that ended, I think, around March of 2022. And before the CSA could do anything, two other events happened. The SEC in the US came out with its own set of proposed rules. They were a bit more prescriptive, where the CSA allowed some voluntary disclosures. The SEC was a bit more prescriptive around a couple of items. And the ISSB came out with a couple of exposure drafts around sustainability disclosure and climate-related disclosure. So the CSA is now looking at all of this and what's going on in the world and trying to figure out what it might want to do. And what we did was, when I mentioned the Fasken ESG disclosure study that came out a couple days ago, we were curious in looking at what are companies doing right now? What kind of standards and frameworks are they even talking about, referencing? And two things came out. One, there's three frameworks that get mentioned frequently. The SASB, the TCFD, and the GRI, the Global Reporting Initiative, get mentioned often. And companies are mentioning more than one framework. They're not just relying on one, but they're mentioning more than one framework. So, starting point. Any reaction to this? Is it surprising that companies are mentioning more than one? Is it surprising that SASB, TCFD, and GRI are mentioned so often? Do you want to start with that, and we'll go to Alison?
I will say that investors are, I recall the day when it was just GRI, and I think G4 standard was coming up in SASB. And TCFD is very different, and so I think there's a reason for that. And I will say, from a corporate perspective, investors have asked us for different things, and so sometimes the response is to do it all, so to speak, or to do these are the large ones. Now, what I will say is very exciting for someone in the corporate who does sustainability reporting. The ISSB, I think, will solve some of the issues in terms of these duplication. Already, the value reporting framework has put a number of these have merged together. I think TCFD is still going to stand on its own, so it'll be TCFD and ISSB, and I think ISSB is going to point to TCFD, and they're all going to point to each other. So for people like myself, my team who does this, a little bit more clarity. I think the one thing that's not going to be solved through ISSB is it's still going to be largely qualitative, or some of the requirements are going to be not as prescriptive as I think some people are going to hope, because, again, it's very difficult to get some of that quantitative stuff.
And by that, you mean the data gathering exercise is still a challenge, and to quantify that data is still a challenge. We're still not quite there yet.
Yeah, and I guess as an example, I think on the climate side, the ISSB will be able to be a bit more prescriptive, but just generally, it's going to be hard to put out a standard for all sectors and all industries. And that's what SASB was trying to accomplish, right? SASB was trying to do some things that were industry and sector based, but it's going to be hard to put out requirements that's going to be a be and an end all for everyone. And so I think it's going to be a little bit more broader, and people are going to have to do more interpretation, and it won't be as prescriptive. So that's to clarify my comments.
Alison, your thoughts?
I agree completely. I think maybe I'll just make a couple of points. One, and I don't have the memory coming right to the fore, but it's been I think, when did accounting standards come out? After the Great Depression? So less than 100 years ago, and they still get changed every year. That's just for dollars and cents. And so there's a real challenge. The ISSB is looking at, because we're all the ESG issues and trying to get to something sensible in a much shorter period of time. So I think all of us in the investor community have to be a little bit patient on some of these things. There's an extremely high cost of compliance. I mean, we also get pressure from our stakeholders to disclose all this stuff, and it's like, well, our companies don't disclose this. We can't. So it's extremely easy to say, give us all this. It's much harder to actually produce it. So I agree completely. I think the ISSB process is very encouraging. They've got their work cut out for them, but they are tied into the accounting profession. So I suspect in time we'll get a bit more clarity there. At the same time, there are other pressures, and this isn't all of the efforts underway. And there's at least two other things I will note that, if you sort of thinking forward, one is the carbon, what was called the Carbon Disclosure Project, now CDP, and yet another acronym. That's also being heavily used by investors for high emitting areas. And then there's a very strong movement towards more nature-based and biodiversity-based reporting as well. So there's a TCFD for nature, to use a quick moniker. All this stuff investors are gathering together and throwing at the industry, and we're pretty careful about what we can barely handle this, never mind throwing it out there. So I do think there is some patience that the investor, and structure and discipline that the investor community has to bring to some of this conversation, and which is why I agree with everything you said. I think there's a lot to be encouraged about with the ISSB, but this isn't going to happen overnight, so we got to have patience.
Okay, so we don't have perfect clarity yet, and it's going to evolve. So for some companies, particularly small companies, that are confused, overwhelmed, I guess it's fair to say, I mean, the frameworks are really a way to think about things, a way to logically come at this. And so if you choose a framework and you start to think about your risks and opportunities under that framework, you're probably not going to go wrong. Is that fair to say in terms of just how to approach ESG? If you've never done this before as a small company, could they go wrong in choosing one framework over another?
I think it's sector specific.
Okay.
So I think some of the climate stuff is going to be very specific, very important for the high emitting sectors. And I think again, if ISSB comes out with their exposure drafts, it'll clarify some of the frameworks and some, let's say, headings, topics, areas. I think what ISSB is also going to bring to the table, and this is to our accounting peers and professionals, is some structure to the reporting process, like just from a process and controls perspective. And so I think it's interesting because even from a reporting perspective, a lot of these ESG reports have sit under compliance, legal risk. It's all going to move on. I think it's going to move under finance. And so I think it's that even for smaller companies, yes, it's a framework to think about the issues, but it's also about process, to think about how you collect the data, how you produce how you vet the data, that sort of piece that ISSB is going to bring to the table.
Alison, you go ahead.
We work with a lot of smaller companies, private ones, and then so less public, but I have in other realms of my life, and it goes back to that concept of materiality. And so I think the frameworks can be very useful to help you sort of think through things, but ultimately it's up to a small company to be disciplined about the handful of things that they can focus on and actually meaningfully collect information on that drives the business forward. And so that can be overwhelming when you're looking at, all these multiple of frameworks and all these data points. And so I always sort of caution, just don't let perfection be the enemy of starting to develop those muscles, because no matter what frameworks come down, that kind of thing, if you haven't done the work to sort of figure out what this might mean for you, it's going to be a lot harder when, we get hit with these, whether they're regulatory or just, advisory, whatever the right words are. So
Okay.
Develop the muscles now, start your jogging routine.
Fair point. Bindu, your point about it ending up under the finance function, can you remember to raise that one more time when we come to talking about risks around setting targets? I want to come back to that point because it's important. But let's move to compensation. The other data point that we wanted to investigate in our study was, are companies thinking about ESG in their compensation practices, and are they linking executive compensation to ESG metrics? And what we found was that many companies, over half the companies that we surveyed, are referencing ESG metrics as part of their compensation considerations. Most of them are referencing them as part of, kind of lumped in with other metrics. A few of them are referencing just ESG considerations by themselves, and a few fewer are looking at specific E issues or specific S issues. The second thing that we found was when they're looking at ESG metrics in relation to compensation, if we go to the next slide, a lot of them are tying ESG metrics to short-term compensation versus long-term compensation. And to me, I think I understand that, but I'm curious, any reaction from both of you on, do we expect to see more traction in this area? What are the difficulties around tying compensation to ESG metrics? Actually, Alison, why don't you start from a conceptual level, and then Bindu, you will have lived and breathed this from a corporation, and it'd be interesting, I think, for the audience to hear how you guys have done this. So Alison, we'll start with you.
Sure. Well, you're absolutely right. This is a thing now, and so even within year over year, you're seeing material percentage increase in the number of companies that are announcing ESG linked compensation. I suppose to apply a slightly cynical lens to it, because it's all happened very quickly, the substance and rigor around these compensation plans when it comes to ESG, I think is it's a little bit all over the place, and it isn't. It's linked to this data issue that we also spoke about. So often, and again, I haven't scrutinized this in aggregate of every company, but they can often be quite qualitative, quite low bar, like I hired a woman, well, good for you, very easy to achieve. So it's really about getting a headline to say we're linking ESG to our comp than, really digging into the real value, getting back to the value drivers of the business. So I think, conceptually, there's just, a few questions we probably want to ask. And I think you might have mentioned this in your proxy voting comments, but I anticipate there's going to be increased scrutiny from the proxy providers on the caliber of these exec comp ESG links in the coming years. But at minimum, I think there's a few things to think about. I mean, one of them is frankly, a lot of this stuff has a strong intrinsic motivation that can be very challenging to link to, the metric. So, you want to hire executives who are intrinsically motivated for, whatever it is that you're trying to do, not say, okay, I'll tie 1.1% of your comp over here to this little thing. So there's a lot of this that is about intrinsic motivation that I'm not positive a compensation plan is going to completely focus on all the time. That said, compensation does drive incentives. We know that. So, I mean, I just wrote a few things to think about. One is, these should be pretty specific with an actual bar. There's another study that shows that, so I think it was something like 95% of ESG pay, like they hit the bar. So it's not, it's something they're probably already doing versus something that's actually incenting a change is what that suggests. So, most people are recommending, you've got to start figuring out what the right metrics are. You've got to get your head around the metrics over a period of time before you can actually link it to compensation, which is why I'm a little skeptical because I know the metrics aren't always where they need to be. I mentioned the sort of link to the driver of value for the business. And then the third point, which you mentioned, is the time horizon point. When you're getting into a lot of these sustainability issues, if you're trying to transition a carbon heavy business into something else, that can't happen even in 3 years. So you have to be really careful that if you're really talking about a long-term transition in your business, you're not going to necessarily incentivize that under a lot of the compensation structures that may exist today. So I think there's a lot of things to scrutinize on this, and I anticipate there will be a lot more scrutiny past the headlines in the years to come on these plans.
This long-term point is really important, and we'll see if we have time to dig into that further. But Bindu, you guys have lived and breathed this for a long time. How do you address ESG metrics related to compensation?
Yeah, so this is our third fiscal that we have something called the ESG index that we've been and my team monitors and reports to the board quarterly. And at the end of the year, it is 10% of our business performance factor. So it's 10% of variable compensation for the majority of all employees. So it's not just executives. I say majority because there's certain employees, the lawyers in the room will know there's certain employees that are, comp specific, but the majority of our employees, from the people in our branch, our customer service representatives from the branch networks to our executives, this is part of their compensation. I think when it was put together, there was a lot of thought put into that piece about quantitative and qualitative. So I will, you can look at our last year's proxy and more to come in our upcoming proxy. We have our public metrics that are quantitative are included in the index, and we have a number of metrics as well and targets that are not public. So we have both quantitative and qualitative. I can't think off the top of my head as to what's the percentage of the breakdown, but it's really important for us, even for the qualitative ones. We have something called performance assessment ranges. We have a methodology to assess and factors that need to be met, and sort of it's become, with the help of a number of people internally in different groups like risk, internal audit, we've developed a methodology to assess the different metrics and targets. And that's really important because it is tied to compensation. And I think the other piece is what we've really focused on in the last year is to make sure that what is in the index is tied to our ESG strategy. So it's not a collection of what's out there and what do we have in the business. The public ones are obviously tied to our strategy, but also the non-public ones that we're working towards. And I think what's really effective for myself as someone who runs the strategy is it gives me a measure, it gives executives a measure against the strategy, and it gives a board line of sight as where we're going, and it drives action and initiatives both within a particular business unit or a functional group, because everybody's got a sort of a stake in it. And so we also have executives tied to each metrics. It's quite a complex matrix, but it was an evolution, right? Like it took time. And I think in fiscal 21 is when CIBC first initiated it in the actual compensation model, but it had been thought about for some time. And it's, particularly the compensation folks have really been purposeful as to sort of developing that. Now, the one lesson we learned in talking to investors is that a lot of FIs have this sort of ESG component with their client experience metric. We had divided it separately. We wanted to identify what pieces were client experience and what we, ESG. And that was getting lost in translation because I thought it was clear in Proxy, but when we were having meetings with investors, they didn't see that sort of, they would looked at the big bucket of client experience and ESG, and they were like, oh, you guys, you guys you're only at 10%, other people are at X%. And so that's an interesting discussion as to what investors think is in ESG. Is client experience part of ESG? Is it not part of ESG? So that I think you'd have to have discussions with your stakeholders and your investors in particular, because I think that's important, and that's the labeling issue.
Back to topic one.
Yeah, it's the labeling issue.
Yeah, I mean, this feels like it's such a deep topic. There's so many interesting questions around this. For example, on long-term compensation, when you think of a corporation and you look at most proxy circulars, long-term compensation consists of RSUs or stock options. RSUs typically last 3 to 5 years. Stock options expire in 10 years. In the ESG space, when you think about environmental targets, people are setting targets for 2050. And so there's work to be done around how compensation schemes even work for that period of time. We talked a little bit about compensation clawbacks. If you make an error in your financial statements and then an executive leaves, there's still potential for clawback of some of that incentive compensation from an executive. That gets really tricky in this space. And so this feels to me like a topic that we're going to come back to each and every year because there's lots of development to happen here.
Yeah, and this is a slightly adjacent point, but another area that we're trying to sort out is it's around the setting of climate-specific targets, and which can tie back into compensation. And so when you look at the nature of, step out of your, individual job and think of the nature of the transition that needs to happen across, every industry. When you want companies to be intentional about target setting, you want those targets to ideally be ambitious, particularly in high-emitting companies, and you really want the focus there. Well, that means that likely a bunch of companies are going to miss those targets. So what's the right role of an investor in this? Because there's on one hand, everybody's pushing through, you've got the CEC in there and Climate Action 100 plus, everybody's pushing for more action and more ambition around this for good reason. At the same time, you also know a lot of these targets are likely to be missed, including the ones that investors themselves are setting for themselves. So should we not set ambitious targets? So I think there has to be a lot of maturity and sensitivity around some of these, and they're quite, they're new areas, they're very untrodden. So, and that's I'm not answering the question, I'm just illustrating the further complexity I anticipate we'll all be grappling with around this.
That's a perfect transition to our next slide, because our next slide is on targets. So the other data point we wanted to look at were what are companies doing around targets? And as it turns out, if we go to the slide before that, a large number of companies are setting net zero targets, saying that we'll achieve net zero by 2050. And if we go to the slide after that, some of those companies are then becoming more specific in terms of disclosing do they have a carbon intensity improvement target? Do they have an absolute GHG emissions target? So knowing that companies are doing this, I take your point. Like as an investor, it's good that they're setting targets, have to set expectations that they may not hit them. What are some of the things that companies should be thinking about on whether to set a target, and if they do set a target, how do they manage to that? Who wants to start? Bindu?
Yes, we have. We come out with two. I think when we think about frameworks, there's all this disclosure frameworks. Well, there's a whole bunch of frameworks around target setting. Like that's a whole other, NZBA, SBTI, there's a whole bunch of alphabet soup around that. What I can say as someone who's been through the process, I think it's important. We've set a net zero ambition. It's a framework and it's something we're working towards. And setting interim targets was part of that. Like you can't say 2050 and not set interim targets. Once you do that, it's really important to get the skill set and the expertise to do the methodology right. It is a very technical and scientific, or what I call our algebra equation. I had to pull up my math books again. It's a very precise and not precise at the same time. You're creating a methodology and a formula with data that's proxied somewhat there for different sectors. So it's quite a complex situation. And what I will appreciate in the conversations with investors in the last 12 to 18 months is there's been a learning on both sides, right? So we're all learning how to do this. We're all learning how to set these, and so we could ask the appropriate questions. And so if companies are thinking of doing this, you have to invest in the skill set. And there's very few people who have it right now, or invest in the learning, because it's not an easy process, but it's important because it is a tool in your evaluation. It's one, target setting is one tool among a number of tools that we have in terms of how we work with our clients to transition. It's not the be and end all, but it's an important piece of it.
Alison, your thoughts?
Yeah, I mean, I agree. We're clear in our proxy advice that, we expect companies to have plans with targets. We also have to have, like you, the net zero ambition, we have some internal goals, targets. A lot of them are still qualitative. So we are not immune to this ourselves, but it's extremely, extremely difficult. So, I mean, this is where it's easy to say this, it's much harder to do it in the market response. I think this is where my point about kind of the kindness and the maturity and the educational process that we have to go through as an industry is going to be rough. There's also what does a good target look like? So, I mean, we'll talk about the proxying of data. I think that's a really important one. We are heavily relying on proxies. That's an indicator of risk in our portfolio. It's very hard to use that to set a target because it's not a real number in our business. So our business could do a bunch of stuff, but our proxy is only going to change if the industry changes. So, the nature of whether it's a GHG reduction target in particular areas, I think it's hard to do if you don't actually have good data. We might need to get to a place where we have other sorts of targets, whether in our case it's things like a portfolio coverage, increased confidence in the data. People the activists will come at us, they'll come at others and say that's insufficient, but unfortunately that's just where we're at. And we have to be honest and forthright about that.
And that's why I think it's really important that it's not an interim target or a target is not the only source of evaluation. Because right now, where the data is available is really if you even think of the highest emitting sectors, 2019. We did 2020 for our oil and gas portfolio and our power generation target. A lot of work, in terms of timing when it's available, and even that's proxy to an extent. So if you're thinking about, it's a lag indicator. Like when a number of us are coming out with our performance measure, our performance against our targets in March, but it's 2-year data from 2 years ago. And so I'd caution against that from all perspectives, is that being the only evaluation factor.
So, Bindu, I want to go back to a point you raised before. So you set a target to, let's say, reduce emissions. You have to track what your emissions are and disclose those emissions. Let's talk a little bit about why you think a lot of this ends up under the finance group.
Oh, okay.
And go back to that point.
I've been at a number of peer roundtables, and the U.S. banks, because of the SEC disclosure requirements, have been thinking about this or frankly been moving faster than, investing resources and into this and thinking about it because of the SEC is going to get very prescriptive very quickly. And someone, there was a former chief risk officer of a U.S. bank who said, we had to decide, do we teach the climate folks or the sustainability folks SOX and accounting rules, or do we teach the accounting folks about climate and disclosure? Because what is coming we're not there yet, but it's moving in the direction of the requirement for processes and controls akin to SOX reporting. And I think that's why, not all of it, I'm not saying that my job's going to be defunct, but I will still be, responsible from a reporting and from a strategy perspective, but similar to, depends how different companies work, your finance folks are responsible for your MD&A and the processes around that. I think finance folks are going to be engaged in that sort of overview and oversight of sustainability or ESG reporting.
That's helpful. Okay, so we're almost at the end of time, but there's a couple of topics I wouldn't mind touching on very, very quickly. Alison, I'm going to start with you. We've talked about mostly public companies. Is this relevant to private companies?
Yes. So similar to the point about we're trying to throw sustainability standards on, a thing in 5 years when we took 80 years to get our accounting standards. Very similar in private markets. For a long time, there was a free pass there. And now I think there's a lot of attention on private market companies to catch up to where, notwithstanding our conversation, where public markets are. So maybe I'll just, I think that's expected, especially if you're selling, through you're looking to exit in some way to a public issuer or an IPO. You got to have your game on for this. I'll just mention for those who aren't aware of it, there is a really encouraging development that I think, and credit to, there's about 250 GPs and LPs involved in it now, called the ESG Data Convergence Initiative, which has, I see you nodding, at least one person knows of it, which has tried to put some it has put some initial standards around disclosure on 6 different ES and G areas. Again, it's not as complex as SASB and GRI and all these things, but it's a simple start. So we're seeing, at least in our portfolio, about 25% of our funds have agreed to disclose against this. It's just a start. There's 6 areas. They cover all the couple E, couple S, couple G. So I always think if you're going to start somewhere and you're in the private area, that's a really good first place to start. And you can jump forward over a lot of this complexity and technical stuff that we've been talking about.
Bindu, comment around investor engagement, the importance being proactive versus responding. How do you guys think about investor engagement?
Yeah, no, I it's paramount in what my team does. We're focused on strategy and governance and stakeholder engagement. I think the dialogue with investors is really important to sort of hear what's important to them, for them to hear what we're doing, and also to get that feedback as to when we on the ESG index, for example, about clarity and questions and sort of driving and pushing forward to see what they want to see. So I think it's absolutely important. And if you think about where shareholder proposals are going and the rise of ESG related proposals, it's the number one issue for, at least in our space and among our peers. So that engagement and that dialogue is important.
And the last point is on ESG pushback. And what, people say all kinds of things, such as, Tesla gets a low ESG rating. It's an electric car company. Why is that? This is all meaningless. An ESG pushback, is it real? Like, is there something to it? And how can companies kind of prevent, or how can they react to the pushback? Like, how do they not get caught up in the crosshairs of somebody who's targeted them?
So I think the pushback is real. I think there's a couple of elements to it. One of it is, and they're both a byproduct of the misuse of the term and when you're everything, you're nothing. And so you've got all sorts of people using that term for their own ends. So, I think there's a couple of things. So I'll go back to what I said at the beginning. First, it's a framework for risk and opportunity assessment. So I actually thought that Tesla thing was a great discussion point because the concerns that a lot of people who made those decisions had was really governance concerns, which I don't know, we can all agree maybe Elon Musk has not conducted himself perfectly. So maybe there were some risks there that were wisely identified, notwithstanding the validity of the business and the sector it's in and the impact it's had. So I think we have to go back to that, understanding what it is and what it's for. The second thing that I think we should all keep our eye on here in Canada is how ESG has been politicized in the United States. So in the pension industry, about half the states, Republican-dominated states, have passed or in the process of various kind of legislative maneuvering, banning ESG or banning coal divestment in their pension plans, banning BlackRock because it's too it's silly. It's ESG, but it is a real challenge. I think I don't know can't remember what you said about at the beginning, but for a number of years I ran a democracy organization, so I followed politics very closely, and the politicization of ESG in our discourse and how that will knock into some of these regulatory areas, I think is something we really have to keep our eye on. It's not an accident that these SEC movements on climate, which I think are very positive personally. I say that as an investor and as a citizen. Those are positive conversations. We're moving that forward in a positive way. That could be turned around very quickly in a politicized regulatory environment. Here in Canada, I think, at least from a pension perspective, we're a bit inculcated. We don't have the same structure around our governance, but I wouldn't be surprised if we started to see, a similar use of ESG as a wedge issue, and that is not going to be constructive at all. So I do think these are real things we have to be sensitive to. And the more precise and specific we can be when we're talking about ES or G considerations going forward, I think that at least that's one way to help.
That's a really good point. Bindu, last word to you on this.
Yeah, no, I agree with Alison and everything that you said. The politicization we have to watch for. I think the other piece in all this, in the pushback, is the need for transparency and the clarity of definitions. And with that will come out hopefully a response to some of these issues where people are pushing back on. I'm not as I do think it's the environment, the current environment, the economy, the politicization. I remember 10 years ago, talking to folks about ESG and nobody. People were mocking then, so I'm not as fussed about the pushback right now. But I do agree with you. Politicization is going to be the big piece.
We are just over time, and both of you are going to be around for the reception for a little bit. So what I'd encourage is anybody that has a question, maybe we'll carry that in the conversation in the reception right after this. Alison, Bindu, thank you so much for being here and walking us through these considerations. I feel like we could have both of you sit and talk about a number of issues, and we would all be smarter for having heard you just chat amongst yourselves. So really appreciate your perspectives on this. And to our audience online, stay tuned for the email. And for our audience in person, please stay for the reception. Once again, we wish everybody a very happy New Year. Stay well, and we will see you next year at the same session.